Now, live from KUSI, this is Good Business San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we're talking about the topics that are important to you, your home, your family, your health, and your money. And the following portion of Good Business San Diego is sponsored by Wilsey Asset Management. Today, we welcome back Chase Wilsey, Vice President of Wilsey Asset Management. And with the Dow, S&P 500, and NASDAQ all near record levels, should you be worried about the stock market? Well, here's Chase with his perspective.
Thanks, Roy. And when we look at it, obviously it's great to see record high after record high for the markets. But I got to say, as it continues to climb, it seems like day after day, I do get more and more concerned. Big reason for that, number one, is the valuations. If you look at what we call the forward PE multiple, that's what you're paying for the future earnings of the stock market, it's now around 22, 23 times. You look back over the last 30 years, the historical average is about 17. We really haven't seen this type of valuation since the tech boom, and we know how that ended for investors. Also, we look at different indicators, including the Buffett indicator. What that is it looks at the stock market value compared to the GDP. Well, right now we've exceeded 200%. Concern here is during the tech boom, we were about 150%, so we're very expensive on that measure. We then also look at something called the Shiller PE. That looks at your last 10 years of earnings adjusted for inflation and then the prices according to that multiple. We're now at about 39 times. Last 30 years, the average is around 28, 29 times. So things are expensive. And we've really seen a heavy concentration in this market. If you look at the S&P 500, right now about 20% is in just 3 companies. That means you have 497 companies that are occupying about 80%, so very heavily tilted towards those big tech companies. One other area that has confused me or concerned me as well has been the margin expansion. And margin is a very dangerous thing. It enables people to borrow money to buy stocks. We recently topped a record $1 trillion in margin debt. Big concern here is we saw one of the fastest 2-month growth rates for margin debt really going back over history. Now, if you look back other periods that saw this type of margin debt expansion, 2007 and 1999. Market did not do well after that. So why is this all happening? Well, a lot of times people, they just love to bid things up. And I believe really we've been for the last 18 years in a long-term bull market. I mean, even 2020, 2022 had very quick recoupments of the losses that you saw in the stock market. The last time we really saw difficulty was during the tech bust. You have to remember, the tech bust, the NASDAQ fell about 79% over a 3-year period. The S&P was down about 49%. It took you 7 years to get back to break even had you invest in the S&P 500, and 15 years had you invest in the NASDAQ at the peak. That wasn't the only time in history that we've seen something like that. Actually, the Dow in 1964 to 1981 gained just 1 point. So there's a lot of concern. I think a lot of investors at this point in time, they don't really remember those difficult time periods. So the market, in my viewpoint, has just gotten way too expensive. Right now, we're sticking to value investing. During 2000, when growth stocks really struggled, value is actually up 7% that year. So value can still do very well during difficult markets, and we're holding a lot of cash. If you like this information, be sure to go to smartinvesting2000.com. Be able to sign up for our newsletter, view the podcast, get other good information. Thanks for the time, Roy.
Chase, thanks so much. Really appreciate it. The preceding portion of Good Business San Diego sponsored by Wilsey Asset Management, and we will be right back.